let's get started. Welcome. My name is Patrick Gallagher. I'm with the ELC team. I help produce all of our events, our conferences, podcasts, and all of our other content. Our big question today is about angel investing. How does it work? How do I decide what startups to invest in? What stage should I invest in? What are the benefits and rewards? Where do I even begin? And these are many of the questions that Lee Edwards will help us answer today as we discuss how to get started with angel investing. So as you all are joining, we'd love for you to share in the chat, where are you coming from? What are you excited to hear about? We also have a poll that's going to be shared in a moment. So we'd love to hear your thoughts about the poll. And the question is, how soon do you want to get started angel investing? Is this I'm ready to go right now, I'm looking for a great company to get involved with? Or is this a 3 to 6 to 12-month commitment? We'd love to hear your thoughts there. Or if you're somebody who's like, I'm not sure yet, I'm just here to get to a sense of what this is all about. We'd love to hear from you. So feel free to share your response in that poll. And so here's how our time's going to go together. Lee and our moderator, Sanaz Tavakkol, are going to chat for about 30 minutes. And then we've invited a few community members who are going to be joining us live. And so you'll be able to expand on what you've learned through their different examples and case studies. And we'll also be incorporating Q&A throughout. And for this event, because it is a smaller format event, we also have space for people to jump in and join us live. So if you'd like to jump in and ask your question of Lee live, raise your hand and we will invite you up to get involved in the discussion. And lastly, make sure you write your ideas down, because at the end, we're going to crowdsource different ideas and see if we can kick off some community support for you in your angel investing endeavors. So something that's going to be really, really cool. Okay. Let me introduce you to our speakers. So Lee Edwards is a partner at Root Ventures. Previously, he was the CTO at Teespring. Before his time at Teespring, Lee was a mechanical engineer at iRobot, a software engineer at Pivotal Labs, a lead engineer at SideTour, which was acquired by Groupon in 2013, and engineering manager for GrouponLive. Our moderator is Sanaz Tavakkol. She is a founding member and principal software engineer at LimeSpot. She leads the AI development and manages all phases of technology development for the organization. Lee, Sanaz, thank you both so much for joining us.
Yeah, glad to be here.
Yeah.
Take it away. The show is yours.
Cool. So thank you so much, Patrick, for the intro. I'm going to start with my first and very basic question of what is angel investing? Can you please, Lee, give us some intro on that?
Yeah, angel investing is basically writing a check into a company, buying some equity, typically at the early stage. I think most commonly sort of at the seed stage, but you see angel investors investing in startups really at any stage.
Mm-hmm. How would you qualify to become an angel investor? How would you get started? Your journey into becoming an investor.
Yeah, so there are SEC requirements that that you should look up. I'd be not a lawyer, so you can find this easily to be an accredited investor. But yeah, anyone who sort of meets those requirements can be an angel investor. So there's a lot of ways to get started. It very much depends on your goals. So I think that's probably the first thing, is to figure out, are you doing this kind of for fun? Are you doing it to support your friends? Are you trying to make a return on your investment?
Mm-hmm.
Or are you using it to kind of build a track record to potentially get into venture capital?
I see. So actually my next question was that how is angel investing different from other type of investments such as venture capitalists? Can you elaborate on that?
Yeah, so definitionally, angel investing is using your own money, and venture capital is investing other people's money. So there ends up being kind of a lot of differences that come out of that. I think typically venture capital is writing much larger checks, although not always. We're seeing kind of a lot of micro VC funds, particularly from, say, operators, as we call them, meaning people with real jobs, basically raising say like $1 million, $5 million from their friends, and then investing maybe 10, 25, 50, 100, 250K per investment. So yeah, basically with venture capital, you have what we call LPs, so they're investors in our fund, and they often include things like college endowments or family offices, maybe some individuals, and sovereign wealth funds, pretty common. And you're essentially investing money on their behalf. We're promising our LPs that we'll give them greater returns than the market. So typically what folks are looking for is kind of to 3x their investment. But it's high risk, high reward, and angel investing is quite different. I think a lot of angel investors just sort of want to support their friends, kind of trust that if they invest in the community, their money might come back to them. Maybe they'll make a little money, maybe they'll lose a little money, but they don't care that much because they're kind of supporting their friends. All the way to, you know, people trying to actually like really make some money angel investing, which can definitely happen.
Makes sense. So, so what is the angel investment benefit to a company compared to other types of investments? So why would a company go with angel investing as opposed to other types?
Yeah, a few things. I think one is just when a company is getting started, maybe they raise like what we call a friends and family round. So you may ask people in your network, and you kind of call it friends and family, even if your family is not wealthy and investing in your company for whatever reason. Or maybe people also call it an angel round these days. But maybe you're raising $100,000, $250,000 to kind of get your company started. Bringing in angel investors can be a good idea. You can sort of get maybe more favorable terms, sort of sell less equity in your company for more money, and not have venture capitalists kind of demanding like high growth at this moment. But have enough money for your startup costs. Like you maybe need to just get some hosting, maybe pay yourself a bit of salary, potentially hire someone or have multiple co-founders getting paid salary. And then the other big thing is like the help that angel investors can provide. So even we'll do rounds where maybe it's a $3 million round and Root's putting in like $1 million to $1.5 million. And we still bring angel investors into that round. And the reason is they typically are very value adds. Like a recent deal we did, we had Adam Gross, former CEO of Heroku, as one of the investors because he's just got a ton of experience, obviously, in building kind of platform as a service business. And Jason Warner as well from GitHub. So I think a lot of times especially if you're an engineer, operator, engineering manager, CTO, technical leader of some kind, you can provide a lot of value to a startup. And I think that kind of takes the form of introducing them to customers. If they have the kind of business where maybe you have a really good connection to their customers, or introductions to distribution platforms. So for example, Heroku, right, this is a really good connection for this company where Heroku is actually a really great platform. But I actually think one of the best things that you can do as an engineering leader is kind of the mentorship, much less so management. I mean, it's really not management, but kind of the mentorship part of your leadership job where you're kind of an ear that someone can bend, just sort of providing like that moral support, or even advice on hiring. Like a lot of times some founders, maybe there are some great founders who've never been engineering managers before. Or managers of any kind. And so just giving them the playbook of like, here's how you might hire, I'll help you interview someone, or you're firing someone for the first time in your career. Let me walk you through how you might do that. So yeah, I mean, I found that among sort of the operator angel investor group, engineering managers and leaders are like very highly desired by early stage startups.
So if I understand correctly, an angel investing, because I've heard the term friends and family fundraising, that is exactly what an angel investor is. They're friends and family investors. And it is not only the money part that helps, it's also the experience that that tech leader as an angel investor provides to help the founders of a new company or startup.
Definitely.
right?
Yeah, but
Which
I'd
is,
also
mhm,
I would also say angel investors often come in later rounds as well, later than the friends and family round. And they're also sometimes like not really even your friends and family, like maybe they came through your network. Maybe your friend is at a company and their coworker is angel investing. So they do the introduction and an investment
mhm.
happens that way.
All right, sounds great. Yeah, makes sense. Other types of involvements that an angel investor has in development of a startup, like would the angel investor even be part of the team at that stage of being an angel investor? How would you put that? The
Yeah,
collaboration.
I think that you definitely stop short of writing code. But well, I should take that back actually, kind of. So, I've done a little bit of like dog fooding. I would never like contribute code to a code base, but I definitely have done like where we invest in a company that provides an API. So we're an investor in Daily.co, which makes an API for video chat.
Mm-hmm.
And I made a couple demo apps just because I thought it was useful and kind of fun. And then I wrote a blog post about it. So in a sense, I was kind of helping them with content marketing. Um,
Mm-hmm.
some other folks have read that blog post and kind of like built apps because of it. I had like a deploy to Netlify button too, so you could kind of fork my app. If you check out my GitHub, you can all see this. So yeah, that's like one way you can help. You can really roll up your sleeves and do some work in that way.
Yeah.
Whiteboarding
But
for
you're
architecture.
part of the team in that sense.
Yeah. I think there's an important line you need to kind of draw, and for me, I think it's to be like legitimately helpful and not kind of push yourself on the founder. It's kind of more like my approach has been I'm infinitely available.
Mm-hmm.
And this was both as an angel and now as a professional VC. It's also my philosophy in management, right? Like I think when you're a manager and you're 100% manager,
Mm-hmm.
0% coding, I like to say you're like the most interruptible part of the team. You typically don't want to walk up to an engineer who's coding and be like, hey, a question for you. And they're like, oh no, yeah, like I've lost my train of thought. But as a manager, I think that's part of your job. So I have the same approach as an angel investor and as a VC. Text me anytime, call me anytime. And I get phone calls everywhere from, I had someone call me because they were considering whether using React Native or a native Android development.
Mm-hmm.
I've had people call me on like really personal issues, like someone on the team acting inappropriately, and how do you handle that situation involving HR and firing and separation and all that. To like, I'm feeling down. Being a founder is really hard. I'm need to focus on my mental health. Like I kind of want to talk through this with you. So I think if you're willing to be like that kind of person, I think you're a massively helpful angel investor.
You're literally being an angel, basically.
Yeah, I actually don't even know where the term comes from, to be honest. I don't actually know what the origin is, but
I think
that
it
has
comes
been
from the responsibilities that you're agreeing to take on. So
yeah.
What are the criteria as an angel investor that you consider to start investing in a company? Like, how would you know if an investment is a good investment?
Yeah, it totally depends on your goals. So like I said, I got started basically just being like, I have a lot of smart friends. If my smart friend starts a company, I'll write a check. And sometimes that works out. Like those two investments, one of them is doing really, really well. The other one was acquired by a company that's doing really, really well. And then, so I think, you can sort of do that. Your criteria can just be, I know this person, I trust them, they're smart. If what you're looking for is to build a track record to get into venture capital, or to sort of do this more seriously in some sense, it makes sense to kind of like build a portfolio and say, I think a lot of people will typically say it's about diversification. So you should do maybe say 10 to 12 investments over 1, 2, 3 years. And then in that case, yeah, it's kind of up to you. I think typically people talk about like founder and size of market. So if something is going to be an investable idea in the world of angel investing and venture capital, it needs to be something that targets a huge market. Investing in like a restaurant, for example, is like a very different kind of thing, and I don't know anything at all about that. you want to invest in a company that's on that track to sort of like exponentially or quadratically grow its revenue, customers, and be it somewhere on the track of being like $1 billion company in 8 to 10 years. So combine that with like, do I think this person's going to be a good founder, which I think is, yeah, there's a lot to that. I think there's, if they're strong technically, that's a plus. If they're really good at working with people, managing people, huge plus. They're good at hiring, good plus. Do they understand the industry? Yeah, it's kind of tough. It's kind of like, hiring someone. There's a lot of subjectivity to it, but there's also a lot of, the more data points you have, the better. So I think angel investors so here's the other thing is, as a VC, I'll meet with a founder, 2, 3, maybe 4 or 5 times before investing. As an angel, you can't really demand that much of the founder's time. So if you know them, then great, you have all these touch points. If you don't know them, you probably only really get like 1 meeting, like maybe 2. It's not really fair to demand much more time than that. So you don't have a lot of indication. So maybe you've got references, maybe you, so actually there was someone I invested in, where as an angel, where, one of my closest friend, and actually also angel portfolio, founder told me he said this person was the second best product thinker at Square. And the best product thinker was Jack Dorsey. So I was like, I only got to meet this guy once, but that was a strong endorsement. So yeah, it's kind of fuzzy, right? Do you think this will be $1 billion company? If you're trying to make this a professional investment, that has to be the criteria.
Yeah, makes sense. One question. So as an angel investor, you were talking about creating a portfolio. So do you think and say that it is important that you always focus on one type of an industry? If you're always investing in restaurants, you should always go and invest in restaurants. If you're always investing in tech companies, or no, it doesn't matter. You can like go different ways.
Yeah, I think it depends. I think a lot of people have angel investment portfolios that are pretty diverse in terms of industry. And I think that can work. Certainly if you're doing I'm investing in smart friends and smart people and friends of friends, that's probably how it ends up. If your goal is, hey, I want to be a venture capitalist in this particular vertical, it makes sense for your angel portfolio to kind of line up with that. Or maybe you just sort of say like, hey, I know these industries or this area or this kind of technology really well, and I want to invest in those areas because I know them. I'm going to be, sort of smart about picking. I think all those approaches can work.
Makes sense. So as an angel investor, what kind of companies would you want to invest in terms of size and age and like what stage they're at? So what are the criteria for you?
Yeah, I think so. When I was so my strategy sort of shifted as I mentioned, like when I started as an angel investor, it was invest in my friends' companies. And so I did some investments where the company was like Series C, Series B. Those are not necessarily smart from a returns perspective. I think if you're trying to build a track record or you're trying to get returns, I think you want to invest as early as possible. The earlier you write, the more impact your check will have as well. If someone's raising a $250,000 friends and family round and you write a $50K check, that's great. You're actually contributing like 20% of their capital. You really made a difference. If someone's raising, like for example, the Series C that I invested in, I want to say they were raising like $30 million. So my $10,000 didn't move the needle. I was investing because I wanted to be part of the company and have some skin in the game. But yeah, the math is just sort of, for a given check size, the earlier you invest, the more ownership you have.
Yeah, makes sense. And so I keep hearing you talk about the size of the check. So does it vary? Like what is the size of the check that would work?
Yeah, I think a lot of companies will say they don't really want a check size less than 10K. I think it's pretty common. And I think it's hard to write too big of a check. Like I said, in a lot of these rounds, if someone's raising like $1.5 million, $2 million, usually the lead investor is taking a good chunk of that, or the lead and co-lead. And so if you try to put in like a really big check, like say $250K or something, you're going to crowd out a lot of people. So I think typically I see angels doing sort of like 10K, 25, 50, like maybe 100.
Okay. That's interesting. So you've given us pretty good information on the kind of effects that angel investor brings into the startup. Are there any negative sides to having angel investment in a startup, or is there a startup where the angel investment doesn't work that much for them and some other that it works very well for them?
Yeah, I mean, the math here is that you're like most likely to lose your money. If you look at like data that's out there in venture capital portfolios, right, where people are doing this full time and, working more than 40 hours a week and just kind of honing their skills in the area. Even in venture portfolios, you're looking at like 60% of companies either fail or return the capital. And then it's sort of like less than 0.5% that have that kind of outsized return that you hear about. So statistically, it's not like a great investment. I mean, especially look over the last several years, right? If you had just sort of put that $10,000 in like Apple or even Domino's, you would have made a lot more money than like the average angel return. But it's very different. I mean, I think for a lot of people, it's kind of like a hobby. And maybe for some people, you have sort of let's say angel investment's not a good retirement plan. Like, don't make this your 401k.
Yeah, for sure.
And it can also take time, I think, to do it well. It started for me as a hobby and then ended up being like my only hobby. And so that's when I realized it should be my job. So that can happen. It can suck up a lot of your time.
Yeah. So speaking about it becoming a hobby, so can you tell us more about that? Can it really be a hobby? Because from what you explained, that you are devoting yourself to the startups that you work with or invest in. How can it be a hobby? Because you probably have your own job, and I mean some primary job, and then having that as a primary, as a hobby. Wouldn't they conflict? How does it work?
Yeah, I think that if your strategy is just sort of invest in your friends as they come to you, or things that your friends send you, it can, you see like a deal a week, maybe like 10 deals a month or something. And I think that's kind of a relatively easy thing to do as a hobby. Like maybe take a phone call like during lunch or after work, or if your work is more flexible, maybe you're doing that, during the day, grabbing a coffee or breakfast in the morning, or meeting on the weekends. As you start to say, so when I decided to make this kind of like a more professional move, I basically said, okay, well, I want to meet like 1,000 companies this year. And so then it starts to take a ton of time. If you read, so there's a book I would definitely recommend for anyone getting into angel investing called Angel by Jason Calacanis. Whether or not you like him, he's a very divisive kind of personality, but it's a good book. Modulo, he's has a healthy ego. I think one thing he talks about is like you should meet 100 companies before you do an investment. That starts to look like, okay, this is going to take a lot of time.
Yes, 100%.
Yeah.
Okay. Makes sense. And I have one last question of this round before we start the live session. So what are your expectations as an angel investor when you start collaborating with a startup?
Yeah, I think it's good to set expectations and kind of talk about like working style and everything like that. I mean, there's a lot of angel investors that sort of write the check and disappear. And there's some that sort of treat it as an opportunity to be an advisor. So I think you want to set that expectation with founders. Certainly if you have like a full-time job, this is the kind of thing where, you kind of are going to need to figure out how to get how to balance like your like your time management basically.
Yeah. Okay. Thank you so much. It was a great discussion. So I will hand it over to Patrick to go on with the live session.
Wonderful.
Great.
Thank you so much, Sanaz, and thank you, Lee. There's been a ton of questions that have come up, and I think the thing that's become very clear for me is that everybody's sort of in a different phase of their journey for becoming an angel investor and have a lot of very detailed questions and very context specific. And I think what I've appreciated so far is being able to start to understand some of the thought process and considerations and all of the different variances that this could look like, because it sounds like there is so much dependencies for becoming an angel investor. So I'll be inviting up a couple live participants, but before we jump into that, I wanted to get a sense of where everybody's at in starting as an angel investor. So there's a poll coming up. Would love to hear from you. You know, are you ready now and are actively pursuing deals? Are you within a couple months, 3 to 6 months? Are you within a year, or are you unsure about where to begin? And so I'm going to be inviting up our first live participant in a moment. Roger, you'll be coming up, but I'd love, Roger, first, if you could introduce, you know, who you are and where you're at in terms of becoming an angel investor. I think it would be helpful to get that context before you jump in with your question. And so, Roger, you want to jump in and share what you're up against, your challenge, and where you're at in your angel investing experience?
Sure. Can everyone hear me?
Yes.
Yeah. Okay. Yeah. Thanks, Lee, for the great Q&As. I think a lot of what you said really resonate with what I was thinking about angel investment. So a quick intro of me. So my name is Roger. I'm currently working on a automation startup with a few friends, as one of the co-founder, and I focus on the AI ML part. Like I have a PhD on AI ML. And before this, I was at Snapchat, and before that, I was at Yahoo Research, or doing machine learning applied research. So I have been doing angel investment for a few years, starting from first helping venture capital sourcing and doing due diligence on AI deals. Then I get into angel investment. I was the style was like the family and the friends kind of investor you talk about. So I investing close friends, want to be part of their journey and have a skin in the game. So not like very large check size, like five to six deals so far. And but also doing some advisings and some consultings exchange for equities for a few other startups. Also within my network. So recently I also start investing through AngelList. So I was getting busy and so I didn't have time to actively sourcing deals. So I found that AngelList have good deals, and some of the syndicate leaders, they also start doing they also having doing their good work on due diligence. So just wonder what you're thinking on angel syndicate. Is that a good way to start? Also does allow us to write small check size, right? So able to do that. As I've been doing investment for few years, first was I wasn't looking for return, but as it's been happening for a few years, the outcome tend to be fine, but I would like to if doing investment for a long time, right? We prefer to do it. We want to do it in a more systematic way. So to generate a decent return in order to continue doing that. So just wonder if you have any advice.
Yeah, that's something I didn't mention and really wanted to is, certainly if you need a bunch of capital to start angel investing, especially if you're writing 10, 25, 50K checks and you're trying to do a portfolio of 10 to 12 companies. So I think one really good way to get started, and that Jason talks about this in his book, is you can go to AngelList syndicates. So, AngelList has, the way it works is essentially people can lead a syndicate in an investment. They talk to a founder, they say, great, I want to invest. I think I can build a syndicate of say 100K in size. They go to AngelList, list the deal. And then they may tell their friends, or there's also a way on the AngelList platform to kind of share the deals and make them available. And then other folks can go to AngelList and say, that looks like an interesting company. I'll put $2,000 into this deal. And the AngelList syndicates can kind of set their own rules on the minimums and maximums, but typically, yes, a smaller size check like that will work. So you could basically say, cool, I'm going to devote $20,000 to angel investing over the next 3 years. I'm going to do 10 deals at $2,000, and you can do it that way. And if you want, if you're sourcing deals, you can build your own AngelList syndicate. And the way that works is, I would say, I secured an allocation for $100K in this company. I'm going to write a $2,000 check. I need to find $98,000 from other people to put in the syndicate. So yeah, that's an awesome way to get started. I think both in terms of, building a track record and being able to kind of do the activity without, dropping 6 figures of your own money, as well as, without getting into the details, you can find this on the AngelList site, but there's some upside for you. There's some economics. You earn what's called carried interest on all the other people that invest in your syndicate. When they make money, you make a little bit of money too. It's also a really good way to see those deals. If you wanted to take Jason's advice and say, I want to see 100 deals before I write any check, it's a good way to do it. Just kind of see what's out there. And a lot of times what you'll learn is just sort of, what does the market for deal terms look like? You'll probably find like, hey, there's certain kinds of ideas that just like everyone is doing, and it seems hard to figure out who the winner is. It kind of just calibrates your filter.
I had a follow-up question for this, Lee. So one of our attendees, so for somebody, say, who has no prior investments, would you recommend angel investing individually or going the syndicate route? Do you have any insights about those pathways?
It's kind of up to you. I mean, yeah, if you're investing individually, it's definitely gonna be more expensive, right? So if you're an AngelList syndicate, you can get started with less money. And you can also sort of like ride on some other people's deal flow if you're using AngelList in the way of, finding other deals and joining them. I think either is really viable. It like really depends on your goals. I think another thing to think about for folks that are thinking they may want to become a professional investor is, I do think sort of the more your activity kind of looks like professional venture capital investing, the easier it is to kind of sell that when you apply to join a venture firm or when you start your own. And so the way that matters is, I think the activity at AngelList, if you start a syndicate and you start bringing in other people to invest, that demonstrates kind of a common professional VC activity, which is like raising the LP money. You can sort of convince people, hey, you should invest in me. I'm good at investing. I'll manage your money. And the larger allocation is also a little more similar. So for example, if a company's raising $2 million and $2 million is spoken for, and you convince the founder, hey, I want to write a 10K check. They're going to raise $2 million and $10,000. That's a pretty easy sell. But when you're in my position, I'm writing $1 million checks out of our fund. And so I'm going head to head. You can't sort of expand the round and squeeze in $1 million. So it's a very different thing. That was the most unexpected thing to me, is how often I lose a deal because I go head to head with another seed fund. So I think to some extent, like kind of the larger check you can write, the more you're mimicking that activity. And AngelList syndicates can be really good at that. I think there are people out there that do pretty sizable investments with AngelList syndicates. So you have to build a really big base of syndicate members, but we see 500K, maybe even $1 million sized AngelList syndicates.
I'm going to invite Bernard up as a live participant in a second, but so you'd mentioned a couple pathways, like categories of like motivations for why people become an angel investor. You have kind of the hobbyist route, and then you have the beta track to become a VC. Are there other categories beyond those two that you would spotlight as like what motivates people to become an angel investor?
Yeah, I think one is just sort of, Yeah, there's a couple. So if you look at like advising for equity, being like a startup advisor, it's similar to that, except you have skin in the game. So I think a lot of times an angel investor has a lot more incentive to sort of pick up the phone, help you out, like put in that extra legwork than an advisor does. And then also the upside's bigger. Typically, you can sort of buy a little more ownership than you would get as just an advisor. I think you also kind of get to see what you want in the world. If you think your friend would be a great founder and you really want them to have a company, you can help them with that. If you want to invest in certain areas that you're passionate about, like say, for me, developer community, I think, things like energy and climate change related things or remote work, like you can just kind of invest in what you want the world to have. And then certainly I think in the area of like diverse founders, that was kind of a big driver for me as an angel investor. I had 70% of my companies had a female founder and I think like 25% LGBT. And my investments at Root are pretty similar actually.
Wonderful, thank you. Bernard, do you want to jump in and share your question with Lee?
Yeah, I was just listening to the discussion, following discussion, all the discussion just now. And one thing that was curious that might be good to zone in on is a comment that was made earlier about how oftentimes these investments end up like completely flopping. And so as a professional, like angel investor, does it make sense to like, what's the potential to get like very, very outsized returns as someone who's only doing angel investing as a full-time profession? Let me compare it to, let's say if one is a founder, in the very best case, if the company becomes $1 billion or more dollars, then the founders can get exceedingly high returns. How does that compare with professional angel investors in terms of the distribution of like possible returns and versus the amount of risk that's being taken, et cetera?
Totally. Yeah, I mean, as a founder, you're looking at, having double-digit ownership of the company. So, $1 billion outcome often makes founders, tens and hundreds of millions of dollars. And that's pretty rare. Like it's sort of generational. If you look at, someone had published, and I don't even know if it was accurate because it's sometimes hard to get all the correct information, but someone made a list of like the first investors in Uber and how much money they made. And there were people that put in 25K and they made I want to say singles and tens of millions of dollars on that investment. So that's generational. That's like, once every 10 years, you get something like that. Or, once in a few years. If you look at the statistics for venture capital, as I mentioned, I think it's sort of the 100x return is, on the sort of basis points, I think less than 0.5%. And yeah, I mean, I think folks here that have experience with startups, you just, either working at them or having friends at startups, you just kind of know that most startups fail. So that's just kind of a reality. I think investing in the public markets, that rarely happens. Disney may lose 20% of their value in a quarter, but it doesn't sort of go to zero immediately, pretty much ever. So it's just, there's a high risk reward thing. I think very few people are an angel investor, put 50K into various companies and then make $100 million. It's not really a thing. It's sort of extremely rare. I think what you can kind of look for is like, will some of these investments like 3x, 5x, 10x, 50x and make up for the ones that go to zero?
While you're walking, it sounds like there's somewhat higher risk profile compared to like public stocks, but then the reward is potentially like people do it maybe in some cases for the path it can take them on in terms of networking and such, but also due to like potentially slightly greater overall returns than the stock markets.
Yeah, that's the promise of the whole asset class, right? Whether that's angel investing or venture capital. Yeah, and that's kind of true. Like if you look at, even it's kind of crazy to think, but if you'd invested in Apple even just a few years ago before they hit $1 trillion, And now they're like, who knows, maybe they'll hit 2 trillion. You could, increase like a 1.5x to 2x return on something great. That's great in the public market if you would pick that exact stock. And a 1.5x return in angel investing is not that great. You're really looking for quite a bit more than that.
Cool.
Awesome. Thank you, Bernard. Lee, a follow-up question related to this. So if, say, like the risk factor you're looking for is a 3x or 5x investment, what's a reasonable time frame to expect on that return on investment?
So that's a really tough thing about this. That's one reason a lot of these investments go to zero is you can build a really valuable product that people like and use and love, and you maybe even have some revenue, but it kind of fails as an angel or venture investment unless it has liquidity. So typically that means, the company IPOs. Or recently there's been a lot of interesting vehicles that you can read up on, direct listings and SPACs or kind of other ways that very late stage companies with a lot of revenue can go liquid. And the other is acquisition. And I think this is something I talk a lot about. I think there's a lot of misconceptions about acquisitions. It's no longer, there was a time period where basically Google would just acquire you and pay $1 million an engineer if you totally failed. And those days are long gone. That's not really a thing. Acqui-hires do happen, but they typically just sort of look like normal hiring packages, maybe with a little bit more equity. And investors never see money on that. I mean, if folks here have been on the other side of the table when you've acqui-hired startups at your company, you treat it like a hire, and you'll explicitly say, like, how do we make sure every dollar we put into this deal goes in the hands of the founders and not the investors? So there's no reason for the company to try to give money to the investors. So the really good acquisitions that happen, the sort of like, GitHub acquired by Microsoft kind of outcome, it's strategic. Like, why did Microsoft pay that much money? Why did Facebook pay that much money for Instagram? It's because they had a strategic goal, and like that product and those customers and that team like really aligned with that strategic goal. That's a really hard one to plan for. Like, I think it's always kind of a red flag when a founder's telling you during a pitch, like, oh, we're looking to get acquired, because it's like, it's not only like, do you know Microsoft's strategy today? I think we can all guess at what Microsoft's M&A strategy is today, but we don't know for sure. But more importantly, it's like, what's Microsoft's M&A strategy in 6 years? I think it's really clear that their strategy today is very different from what it was 6 years ago. And so what will it look like 6 years from now? And if your company gets acquired 1 to 2 years in, odds are it's just not a big number. So there's another thing you can do, which is sort of sell secondary, and that does happen for angel investors sometimes. Later stage, like maybe a bigger firm comes in and they want to kind of clean up the cap table, as they call it, like just sort of buy out some of the early angel investors. So there's not just like random people who have voting rights and can demand paperwork and stuff like that. So yeah, that can definitely be a way to get some liquidity. And then there's increasingly other ways to sort of try to sell secondary. There are firms like Industry Ventures is one that I know that will sometimes kind of roll up a bunch of earlier investors and just buy that equity when it's sort of a growth stage company and they think they can make more money on it. And also companies will do stock buyback, often as part of like a later round. So I did one of those recently. And but yeah, the liquidity is the thing, right? Like, I think with an angel portfolio, lots and lots and lots of seed stage companies will raise a Series A, and that typically will look like, a 2x, 3x, maybe 4 or 5x markup on the seed round's valuation. But it's just paper gains. It's not until there's an exit opportunity, you won't make any money. And we've all seen this, right? Like, you can be $1 billion company today and go to zero. Right, we've definitely all seen that.
Thank you, Lee. I'm going to bring up Young Feng in a moment, but so you're talking about like the common scenario where a bigger firm comes in, cleans up the cap tables, and so that got me thinking about, as a new angel investor dealing with terms and trying to navigate what's good, what's not. Do you have any like quick tips on, if somebody's evaluating terms entering into an investment? Are there like traps that people fall into, or common things you'd want to point out of like to avoid or to do in those situations?
Yeah, I think that So first of all, as an angel investor, unless you're sort of the first check-in for like a small friends and family round, you don't really get to set the terms, or you don't, and you don't get to negotiate. So you kind of take it or leave it. There's a school of thought that sort of write a check at any amount, or like at any valuation, and your outliers will make your fund anyway. There's a lot of people that have that approach. I think as a venture fund, have a very different approach, and we're very disciplined about price. And one reason for that is I built a lot of Monte Carlo simulations on venture fund performance, and the math is the math, right? Like people say, well, if this becomes $1 billion company, why do you care what the first valuation is? What's the difference between $1 million and a $2 million for you? And I'm like, yeah, the difference is $1 million. So it's a lot of money. So I think that you can choose to be valuation sensitive. Certainly if you're trying to do this as a way to make yourself some money, I think that's smart. If you're doing it to build a track record and collect logos, maybe it matters less. If you're doing it to help your friends out or to just sort of, participate in the ecosystem, maybe it matters less. But the way to understand venture deals, there's a great book called Venture Deals by Brad Feld that goes through all the mechanics. And it's a relatively short book. It's very dry. There's a lot of like legalese in it, but I think does a great job explaining things. Oh, the other thing I would say is, especially as an angel investor, and we would see this a lot in these kind of early stage rounds, we'd see people like this, the stereotype of this is like founder in like East Texas has like local businessman who wants to support startups, but doesn't understand tech or Silicon Valley or tech startups, and writes them a term sheet that looks like it came from Shark Tank, where, they're going to buy half their company for $100,000. And there's all this structure on the deal, liquidation preferences and weird terms, and maybe like revenue share. And so like, don't join deals like that. Like this is how I think this book is helpful, because it'll also tell you like what's standard and what's not. If you see revenue share, just run. Like that investor has no idea what they're doing.
Great words of wisdom. Let's Yang Feng, if you would like to jump in and ask your question, we'd love to have you come on up.
Okay, yeah, sure. Can you hear me?
Yes, loud and clear.
Okay, cool. So yeah, I'm pretty new to this angel investing, and whatever just now you talk, I think it's very informative for me to understand what's angel investing. For me, I'm currently working for the data science or machine learning engineer in the companies in the Bay Area. So I do have some ideas, for forming either a startup company or find a team to work together. So my question would be from the other side of the table. What do you think will be like the normal channels for a startup or founder teams to meet with the angel investors, or what will be your suggestion to better connect with the angel investors?
Yeah, I think through your network is probably the best, and part of that is you want to really believe and trust in these angel investors if you're bringing them on for advice. So yeah, I definitely see that a lot, where someone maybe came from a company and they had a good relationship with maybe like the CEO or CTO of that company or a manager, and some of those folks are getting into angel investing. So I think if you happen to know that you have friends or former coworkers that are angel investing and you talk to them about it, or if you kind of put a flag up there by tweeting about it, having a website, announcing a fundraising round, putting it in your LinkedIn. Sometimes folks that know you and believe in you will reach out and say, hey, I've been dabbling in angel investing. Do you have any room in this round, or can we talk about what you're working on? So yeah, I mean, other than that, certainly like AngelList is one route, but I think it's, I think kind of blindly finding angel investors from the founder's perspective is definitely less optimal for you.
All right, awesome. Thank you so much, Yang Feng. So Lee, I think this is a great kickoff point to dig in a little bit more into deal flow, because we have had a couple questions come in on the Q&A about how do you get deal flow going. And I know you'd mentioned a few times about tapping into your network, friends and family. Do you have any specific steps or process or a framework for how people can either tap into their network to get deal flow going?
Yeah, so this is an interesting one. I think it's, certainly you'll hear from your friends. You catch up with your friend, used to be over coffee. Now I guess it's over Zoom. And they're like, yeah, I'm thinking of leaving my company and I have this startup idea. Or that, I left the company and I have this startup idea. Or, we're about to raise some money or we just raised some money. That's a great way to, kind of tap into your network. I think another is to try to, I kind of tried to put up a flag when I started doing this and just tell everybody, just like whenever I meet with people, I'm like, yeah, I'm doing a lot of angel investing now. And so if you know anyone, let me know. So if you kind of put that flag up there, people will potentially come to you. Particularly, I think one thing you have to do there is give people a reason to come to you, because the founders especially in Silicon Valley, there's just so many places that they can try to go for capital. So I would tell people, if you know anyone that's looking for an angel investor who's been a CTO, who my value add is going to be, I'm going to help mentor, particularly the technical co-founder, or just sort of be a resource for that. You need something that when a founder or when a lead investor is trying to think of who are some angels that we should talk to, it's almost like brand building, right? They should just be something to think of. So that's another avenue, is VCs. So if you know anyone who's a VC or you know anyone who's an angel investor, talk to them, let them know this is what you're doing. And a lot of times we fill out a round and we basically say, we have room for 3 angel investors. Who do we know? And so we'll always reach for people that we've co-invested with successfully before. Certainly reaching to people I know that have really strong backgrounds in certain areas that I trust, who have just started angel investing. But yeah, when it comes from that angle, it's typically, the founder is going to make the decision. The VC will sort of intro you to the founder. To some extent, at that point, you're pitching the founder, kind of in the similar way that when you're hiring, if you're hiring a really good candidate, everyone knows, you're both interviewing each other. So you kind of have to sell yourself in the way that you sort of sell your company when you're doing hiring. Yeah, and then I guess the other great source of deal flow is your portfolio. I mean, we get tons of really good deal flow from people we've already invested in. And another thing that we get, surprisingly, is folks that we've passed on and haven't ended up investing in. So yeah, again, see 1,000 deals a year, do 2 to 3 investments. There's a lot of no's in there. And there's a lot of good reasons for no that are not, you suck, I hate you, your business idea is stupid, you seem dumb. Most no's are lots of other reasons. So if you kind of build a relationship with the people that you say no to, and they kind of understand why it wasn't a good fit, I keep in touch with a lot of those people, and sometimes they send me deals.
How do you say no while still preserving that relationship?
Well, I think a lot of times the no is not a good fit with the thesis. I mean, I have to say no to everything that's not hard tech, which is our area. So I say no to and also we have sort of a narrow definition of that too. So I say no to all medical tech and biotech and fintech, regardless of how technical it is. I say no to, almost all consumer, enterprise SaaS that's not really focused on technical customers. And so that's an easy one. I think, a lot of times it can be, we went through Y Combinator, and so we can command this crazy valuation. And I'm like, that doesn't work for me. Sometimes actually there's another pretty common one, which is, so sometimes the answer is you're too early, and we do like to invest really early and as early as possible, but this is kind of a complex issue. It sort of depends, right? I think if someone has a really challenging go-to-market and maybe they've got great founders and great technology, but trying to think of a hypothetical example. If you want to sell to restaurants and you're like, our Series A milestone is we're going to get 1,000 restaurants signed on to our product. And I'm like, holy crap, right now is a really hard time to sell to restaurants. So the answer is no, basically because I don't really believe that your go-to-market's going to work. But then that founder surprises you. I'm like, oh my God, they sold to 1,000 restaurants. But by that point, they don't need me anymore. They're such a breakout, they can raise a Series A. So it kind of just, timing didn't work in that case. So yeah, sometimes if you sort of handle that nicely, and maybe the founder, this is why VCs, we sort of get knocked, but when VCs say like, let me know how I can be helpful, sometimes people take you up on that. Like, a really diligent founder might scour their LinkedIn network and say, hey, Lee, I heard that I saw on LinkedIn that you're connected to the manager of this restaurant in Napa Valley. Will you intro me? And I'll do the email intro and kind of build some goodwill that way.
So you mentioned like hard tech is specifically the thesis you're investing in right now. Is that the only types of investment, like companies you're investing in right now, or are there others that you sort of take a look at?
Yeah, so we say hard tech, and by hard we mean sort of difficult, where like we're underwriting technical risk. Maybe the first year or two of the company is technical roadmap. It's always technical founders. We definitely won't invest in a team that doesn't have engineers on the founding team. Certainly at least one. Often they're all engineers. Technical risk is a big part of it, and we're all kind of specialized. So Chrissy on our team was the engineering program manager for Apple Watch, as well as iPod Touch, iPod Nano, and ran a significant part of hardware for Square Reader. So she does a lot of consumer hardware, manufacturing, supply chain, sort of things that she knows. I was a really terrible mechanical engineer and a slightly better software engineer. So that's kind of the area that I focus on. So I think about like AI, ML, software infrastructure, things like that are pretty challenging. And then also areas where like you're selling to software engineers, where I feel like I have an edge on kind of understanding the customer. So I say, sort of dev tools, developer services, applied AI, ML. And then Kane focuses on hard industry. So he likes oil and gas, trains, alternative energy, shipping, agriculture, construction. And a lot of the thread there is a lot of these industries, like they're barely on the cloud, like they just started using Microsoft. And so there's companies out there that can provide services that seem simple to us, but are like pretty revolutionary. So one company, Crux OCM, they do what we would probably all consider like pretty simple machine learning algorithms, kind of linear regressions and some modeling and simulation for fluid control. And it's a huge, huge, both environmental and cost savings in the oil and gas industry. That's kind of our like breadth. It's hard to kind of describe that quickly. So we kind of call it hard tech. If it's technically challenging, if there's really great engineers on the founding team, we'll take a look.
How did you get to that? One of the questions that came in on the Q&A was, as you were explaining your thought process and the things that you're interested in and focus on, one of the big questions was, how did you get to your thesis? Because I think for new angel investors, one of the things that people are thinking about is, I have to have a thesis. How do I begin developing that? Do you have any advice on how you formulated your thesis?
Sure. Yeah. So some people, like I said, some people sort of don't really don't narrow their focus in terms of industry or area or thesis. And that's a fine thing to do. If you're trying to develop a thesis, so for us in particular, as a venture firm, it's maybe a little different. It's kind of, everyone's money is green. So we're a very commoditized industry, which is kind of ironic because we're searching for non-commoditized industries to invest in, but all we're doing is allocating capital. I think to stand out, if you're kind of narrowly focused, I think a lot of people think of us first when they think about hard tech. There's so few investors that want to do hardware, and even fewer. I'm actually pretty sure there's no living VC who's shipped more hardware than Chrissy. Between the Apple Watch, iPod Touch, iPod Nano, and the Square Reader, there's like no way that anyone's shipped more hardware than her in terms of volume. So I think people think of us first for that. And I'm working really hard to get people to think of us first for developer tools. And the reason I picked that there's a lot of areas I invest in, but again, I think it's kind of like a brand story. It's hard to make it complicated. The more simple you make it, I think the more likely people are to think of you. So that's one reason you might have a thesis, is just to kind of differentiate in terms of deal flow. Another is just, think about like, what's my edge? Like, why will I make a better decision here than other people? And so maybe invest in what you know, particularly if it's like a very rare thing. And it certainly is the case that understanding technology is, I wouldn't say rare. It's certainly not rare or unheard of, but it's not the majority. Now, the majority of VCs don't know how to, write JavaScript, for example, or really do technical things. So yeah, maybe that gives you an edge, but maybe not. You look at some of the top investors on the Midas list, and a lot of them are non-engineers. Most of them are non-engineers. So does it necessarily give you an edge? I don't know. I think so. So yeah, I think thinking through that, thinking through what you think about the world. So you can actually see a recent tweet storm I had about developer tools and how I view the world. And there's a lot of smart people that disagree with me in terms of, there are people that think no code's the future. We won't have engineers. We'll be clicking buttons and dragging things around. I don't believe that. But if you believe that, then, make that your thesis, make that part of your thesis and go out and find that stuff.
Really great questions to consider for a lot of that. Now I'm sitting, I have to go back and start journaling my answers for all of those. We have one more live participant. Manoj, would you like to jump in and ask your question with Lee? Jump on in.
Yeah, so very insightful, Lee. I think thinking about, in my mind, I think I thought about investing as a big umbrella, right, which could be at various different stages. And the fact that angel investing could be very different. And the angle around friends and family, I think, was very insightful. Like thinking about that you're investing in people and like the idea, not necessarily like whatever they might have already. But, the question that I had was, how we have private equity, secondary market shares. As an angel investor, do you find yourself wanting to cash out in those markets, or do you actually expect to sort of wait for the actual exit to happen, whether it is acquisition or IPO, or how do you look at your exit strategy in some cases?
Yeah, I think it really depends on your goals. It can a lot of times those secondary sales will happen pretty late stage. So say like SoftBank or Tiger Global comes in, or some larger, more later stage firm. And a lot of times you see when that happens is when they'll start buying angels off the cap table. So at that point, you may be sitting on like a 20x return, and that's awesome. So if you're trying to make money and that's life-changing money, or, even just good money for you, then yeah, maybe it makes sense to do it. In my opinion, you lose when that company IPOs, you kind of lose the right to brag about your angel investment. I don't know, like people do, right? You see people all the time that say angel investor in Uber in their profile. And I don't know how much they invested. Did they lose faith in the company and sell early? Did they invest in a later round? Yeah, maybe. I think that smart founders, smart VCs will sort of see through that and ask the second question about, when did you invest? Did you stick with them through IPO? Did you actually work with the founder, or did you disappear? So yeah, it depends. I think if you're trying to build it as a resume, I personally think it makes sense to stick around as long as possible. But yeah, if you invest 25K in a company, and then if 50Xs and SoftBank wants to buy you off the cap table, that's pretty hard to say no to unless you're kind of fabulously wealthy.
Awesome. Thanks, Manoj. Let's see. So to transition a little bit, Lee, so we've spent some time talking about how to source deal flow for people first starting off. And you had mentioned some of the inflection points being going from sourcing deals from friends, family, and your network to then evaluating over 1,000 deals and companies in a year. What was the story? Like, how did you go from that point to sourcing and evaluating 1,000 deals a year? What was that transition point like?
I think it just sort of started happening. Like I was just sort of, kind of looking at, well, I had kind of made the decision that I wanted to get into venture capital, and that's, I don't know if that's an interesting story or not, but I had sort of applied it's kind of fun. It's sort of like I'll tell it because it's a little bit of a share your failure kind of story in a way. Like I had applied, I didn't think I wanted to do venture capital. There was a firm that said they were hiring an engineer as a new partner. A friend recommended me. I was like, I don't even know that much about venture capital. And did the interview, and through the process, just started doing research. And I was like, this seems really interesting. It feels like a job that I might be good at. But then I didn't get the job. And I was really disappointed. I was way more bummed out than I expected to be. I thought it was just kind of like, I'll explore this and think about it. And then I was like really disappointed. So, so yeah, it kind of made me start thinking, and I was like, yeah, I think this is something that uses a lot of my skills. So I just kind of started, kind of like made a plan that at some point I would do venture capital. And I guess my original thinking was, I also really love being a VP engineering and CTO at, growth stage companies. So maybe I could continue to do that. And then at some point, instead of retiring or towards the end of their career, they move into venture capital. So that was kind of the plan. So angel investing is a great way to build a track record for that. So I started doing that, and I was investing in my friends, my friends. And then they started sending me deals. So I did kind of like my first investment in a founder that I didn't know previously. And then I started kind of poking around in like what all's out there. Can I actually like source companies? And that started to be really fun, and it ends up being a lot of work. And so, yeah, it was just kind of like at that point, it's the same reason I switched from mechanical to software engineering. Was I was doing so much hobby software engineering that I realized, like, if I like my hobby more than my job and I have the potential to make my hobby my job, I should take that opportunity. So that's kind of what ended up happening. And I left Teespring. So I also realized if I really wanted to see 1,000 deals and like really do diligence on these companies, it was going to be a full-time job. So I left Teespring, just kind of jumped into the abyss, and had like no job, no income, kind of being a startup founder basically, and angel investing, and building like a portfolio. So my plan A is another fun story in failure. The first thing I wanted to start a micro fund, but I couldn't get enough people to be interested in investing. I had some awesome people commit to putting in some small amounts of money, but it was not enough to start a fund. So then I ended up meeting Avidan, the founding partner at Root, when I invested in a deal that he ended up then leading the round. So I met him, and he kind of offered me a job, and I said no a few times. And then when the venture fund wasn't coming together, was like, all right, let's give this a try. So we did kind of a try before you buy for about 6 months, which we called an EIR, we called it a venture partner role. And then we liked each other pretty much within like 2 months and made it, a full-time partnership.
You mentioned a failure story. Do you have other like examples of other typical failure modes that engineering leaders run into when angel investing?
Yeah, I think one thing I see that frustrates me is I do think that like sort of when you're providing advice and mentorship, but this applies like anywhere, is to kind of know what you know and know what you don't know. And I've definitely seen some like extremely successful, like later stage technical executives, like just like really impressive people who join larger companies and do great things, giving, I think, really bad advice to early stage startups because they just really don't understand how that works. And I think that's vice versa, right? If you write a small angel check in like a Series C company, like I had done, I have like pretty limited experience with that. I've been a non-founding CTO at a growth stage company, but not a founder at one. And so I try to temper my advice with, I know what I know and I know what I don't know. So yeah, I think that you can end up being a nuisance. Or I've also seen like where they sort of new angel investors, especially if you're investing in, I encountered someone who invested in someone who used to be their direct report. And the relationship seemed to be like a management relationship, which is terrible. The founder really shouldn't be managed by anyone. They shouldn't even be, in that sense, they're not really even managed by the board or any of the investors. Like you're going to be giving updates. Maybe you're even talking every day, but usually not. Maybe you're texting once every couple weeks. But you're not getting like performance reviews in a sense. So yeah, I think it's It's also helpful, you know, also if you've been a founder and you've worked with investors, you probably have formed opinions about these are the modes of operation that I like, and these are the ones that piss me off. And then, you know, try to be the investor that you wish you had had, or model yourself after the best investor you had, right? I think that's something I've definitely tried to do.
Thank you, Lee. So we are coming to the end of our time together, but I want to point everybody's attention to the chat right now. I just shared a link to a Google Doc, and so here's what's going on in the Google Doc. The impact of community and events like this happens when you're able to see how everybody else is applying the different insights that are shared. And so how we wanted to close this event is by harnessing and tapping into the power of community. Some of the big questions that came up are, how do I tap into deal flow? And the big solution was tap into your network and to tell people what you want to be known for and the impact and value you can provide as an angel investor. So we're going to solve a couple of those things and help energize your pathway to becoming an angel investor. So in the Google Doc, there are a couple boxes. So I want you to share an idea that you want to apply from today. So something that was an insight that you were like, that was fantastic. And then the other is share the type of companies that you're interested in. As people are responding, the action that I request that you take is to comment on anybody if you know of an interesting startup in that space. So we're going to start to generate some of that industry knowledge and to get a sense of what's going on in the areas that you're interested in. So definitely check out the Google Doc link in the chat and start filling in what do you want to apply from today and the types of startups you're interested in, and start to comment on if you know of different startups. So for example, I have some friends, if you are interested in the energy and more industrial tech space, I have a couple friends who are looking for their first round of funding for, they're converting, cooling towers and converting them, carbon capture technology to convert that into different building materials. So they've got a setup in Venezuela. So this is my kind of totally unsolicited plug for, they're doing some cool stuff in the sustainable technology space. But if you're interested,
Awesome.
I can definitely hook you up.
Totally. So one other thing I should say, I think, you know, certainly if you're starting a company, you have friends that are starting a company, or you're doing an angel investment and you're looking for a lead investor, you can email me at lee@root.vc. And our parameters are, you know, we're typically writing a check between 500K and 2 million. Average is around 1 million. So actually our average might be 1.1, 1.2 at this point. But that's another great way to interface with VCs. If you send deal flow to VCs, they will love you and they will send you deal flow.
It's great, the reciprocal relationship. And I mean, that's like, so I think symbolic of just any type of ecosystem is that when you support and contribute to other people, then that happens more for you, more likely. So
the pay it forward aspect of this is just incredible.
Absolutely. Lee, I'm gonna ask you to send us off with final words of wisdom in a second, and final words of encouragement to our future angel investors. But the last thing I wanted to point everybody to, so in the chat as well, we have a couple other events coming up. So if you want to continue getting involved in the community, we have topics like high performing teams through purposeful leadership and setting engineering direction in a world where you feel like everything is in opposition. So we have some incredible speakers coming up later on down the road. Check out the events there. But with that, Lee, any final words you'd like to share with everybody who jumped in to kick off their angel investing endeavors? Yeah,
I think, even just kind of riffing on what we were just talking about, I think the thing that I love about investing is the pay it forward kind of approach here, right? Like the reason that I'll help out someone I passed on, or even that's not even anywhere close to my investment area, it always comes back around. Like, you know, you just never know when someone's going to send you a deal, or maybe be available if a founder you invested in says, hey, I'd love to talk to someone from Lyft. And you just, you know, oh, this founder that I met a while ago now works at Lyft, and I'll do the intro. That kind of thing is really awesome. And I think not only there's this sort of, I think that there can be this quid pro quo way to interpret that, but it never feels that way, I think, in the Valley. You kind of throw your help out there and you just have faith that it'll come back to you in some form. And that ecosystem does not exist everywhere, in every industry and in every location. And so I think that if you're doing angel investing and you choose to invest, if a founder just kind of really impresses you and you're not sure about the business or the idea, but if you invest in founders that you would be happy working with, you'll never regret it. Because even if you lose your money, I think you're going to feel like, I supported this person. Particularly if that person feels like they've been overlooked by other people. And I think that plays a lot into what we've been talking about over the past couple months, more and more about diversity and overlooked founders. You just like take a leap of faith on someone. That'd be my advice.
Lee, thank you so much. Incredible words to end on. I don't know if you've had a chance to take a look at what's going on at the Google Doc, but we've got some incredible takeaways that have been shared, and we're starting to see different ways that people are collaborating and sharing information and supporting each other. I'd like to also invite up Sanaz, if you'd like to jump in and share, any final thoughts or the things that really resonated with you from our time together. Jump back in.
Yeah, so it was actually pretty great. I obviously learned a lot of things. Now I could connect so many things that you were talking about, Lee. Having the background coming from a startup background and seeing how all the conversations we had in investments and angel investors that we had in our team. And yeah, it's great. Thank you so much. And there was one book that you also shared the name with us. Could you share that again? So maybe for those who are interested in learning more, or other resources that you would like to share with us, it would be great.
Yeah, I think the two books I always recommend are, it's called Angel by Jason Calacanis, and then Venture Deals by Brad Feld. So Angel is a lot about how to get started as an angel investor, and Venture Deals is all the legal and stuff.
Wonderful. Thank you so much.
Yeah, of course. Thanks for having me.
Wonderful. Well, what's awesome, I'm still just blown away at this Google Doc is people are sharing contact information. We've got LinkedIn profiles going up. We've got emails. So I think the impact of this is entirely in the conversations that we get a chance to create. And so seeing everybody so fired up and excited about, to use your words, Lee, to build the world that they want to see happen, I think is really cool. We have some people really sharing a lot of areas that they're passionate with. So everybody stay on the Google Doc, keep firing away the different ways to help support each other. But with that, we will end our time together. And so just want to say, Lee, Sanaz, thank you so much for creating an incredible conversation. And to everybody who joined in today and is sharing the inspiration of becoming an angel investor, thank you all for spending your time with us as well. We will see you all next time.